Preparing for a financial analyst at AES interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work as a financial analyst at AES? I want to join AES because the role combines rigorous financial analysis with an industry undergoing fundamental change. AES operates across renewables, storage, utilities, and power markets, so analysts can evaluate both stable contracted cash flows and more complex market exposures. I would bring strong Excel, accounting, and communication skills, while learning how investment decisions affect projects, customers, and shareholders. The opportunity to support decarbonization through disciplined analysis is especially motivating to me. While answering, connect your analytical strengths to AES's power, utilities, renewables, and energy transition businesses, while showing interest in decision support, disciplined capital allocation, and the company's global operating environment. Question 2. What do you know about AES's business model? AES develops, owns, and operates energy assets across utilities, renewable generation, energy storage, and other power businesses. Its economics depend on the mix of contracted revenue, such as power purchase agreements, and merchant exposure to market prices. The company also creates value by developing projects, securing financing, operating assets efficiently, and recycling capital. I would analyze each business according to its revenue visibility, operating risks, capital intensity, and long-term strategic role. Make sure to cover AES's generation and utility operations, renewable development, battery storage, power purchase agreements, merchant exposure, project economics, and the importance of reliable cash generation across different markets. Question 3. Walk me through the 3 financial statements and how they connect. The income statement shows revenue, expenses, and net income over a period. Net income flows into retained earnings and starts the cash flow statement. The cash flow statement adjusts net income for non-cash items and working capital movements, then adds investing and financing activity to explain the change in cash. The balance sheet captures ending assets, liabilities, and equity. For example, depreciation lowers earnings and fixed assets, but it is added back in operating cash flow. In your answer, explain income statement profitability, balance sheet changes, cash flow reconciliation, retained earnings, working capital, debt, depreciation, and the requirement that ending cash on the cash flow statement equals balance sheet cash. Question 4. How would you build a financial forecast for an AES renewable project? I would begin with project timing, capacity, expected production, degradation, and the percentage sold under contract. I would forecast revenue using contracted prices and merchant assumptions, then model operating costs, development spending, taxes, working capital, financing, and eventual decommissioning. I would separate operating drivers from financing assumptions so the model remains transparent. Finally, I would run base, downside, and upside cases, checking outputs against comparable projects and engineering expectations. Be sure to mention generation assumptions, contract pricing, degradation, operating expenses, development timing, capital spending, tax effects, financing, working capital, scenario analysis, and checks against operational and market data. Question 5. What is the difference between EBITDA, EBIT, and free cash flow? EBITDA measures earnings before interest, taxes, depreciation, and amortization, while EBIT includes depreciation and amortization. EBITDA is useful for comparing operating performance, but it is not cash flow because it excludes capital expenditures, taxes, working capital, and other cash requirements. Free cash flow is closer to cash available after operating needs and investment spending. In an asset-intensive power company, I would never use EBITDA alone to judge financial flexibility. Focus on the definitions, depreciation and amortization treatment, operating profitability versus cash generation, capital expenditures, taxes, working capital, interest, and why utilities and project businesses require careful interpretation of each metric. Question 6. How would you value a power generation or renewable energy asset? I would primarily use a project-level discounted cash flow model. The key inputs would be production, pricing, contract terms, operating costs, capital expenditures, taxes, useful life, and discount rate. I would model contracted and merchant periods separately because their risk differs. I would cross-check the result using transaction multiples or value per megawatt, then subtract net debt to reach equity value. Sensitivities around power prices, construction costs, and the discount rate would be essential. In your answer, discuss discounted cash flow analysis, contracted versus merchant revenue, operating assumptions, terminal value, project debt, comparable transactions, sensitivity analysis, and the distinction between enterprise and equity value. Question 7. What makes a power purchase agreement financially attractive? A strong power purchase agreement provides predictable revenue for a meaningful portion of the asset's life. I would evaluate price, escalation, tenor, contracted volume, counterparty credit, curtailment rights, renewable certificates, settlement mechanics, and termination provisions. I would also assess whether the contract matches the project's production profile. A high-quality agreement can support debt financing and reduce merchant risk, but an unattractive price or inflexible obligation can destroy value despite revenue certainty. Make sure to cover price and escalation, tenor, volume obligations, credit quality, dispatch and curtailment provisions, renewable certificates, basis risk, termination rights, and how contractual certainty affects project financing. Question 8. How do rising interest rates affect AES's project economics? Rising rates generally increase both the discount rate and the cost of project debt, reducing present value and equity returns. They can also make construction financing and refinancing more expensive, while pressuring debt service coverage ratios. The impact is smaller for projects with fixed-rate debt or strong long-term contracts, although valuations may still decline. I would quantify the effect through sensitivities and consider hedging, leverage changes, contract pricing, and capital timing as potential mitigants. Talk about discount rates, debt costs, valuation, debt service coverage, construction financing, contracted returns, refinancing risk, and possible offsets such as hedging, tax incentives, stronger prices, or improved capital structures. Question 9. Explain net present value and internal rate of return in a project investment decision. Net present value is the present value of expected cash inflows minus the initial and subsequent investment, discounted at the required return. A positive NPV indicates value creation. IRR is the discount rate that makes NPV equal 0, so it expresses the project's return percentage. I would prioritize NPV when projects differ in scale or cash flow timing, because IRR can rank smaller investments more favorably. I would use both metrics alongside risk and strategic considerations. Focus on discounted cash flows, required return, value creation, reinvestment assumptions, mutually exclusive projects, timing, scale differences, and why NPV should generally be the primary decision metric. Question 10. How would you analyze a variance between budgeted and actual results? I would first quantify the variance and identify whether it is favorable or unfavorable. Then I would separate price, volume, mix, timing, foreign exchange, operating, and one-time effects. For a renewable asset, lower revenue might reflect production shortfalls, curtailment, pricing, or contract settlement. I would validate the explanation with operational and accounting teams, determine whether the issue is temporary or structural, update the forecast if necessary, and communicate the financial and managerial actions clearly. Be sure to mention isolating the variance, separating price, volume, mix, timing, and one-time effects, validating source data, speaking with operators, assessing forecast implications, and communicating actionable conclusions. Question 11. What is working capital, and why does it matter for an energy company? Working capital represents short-term operating assets and liabilities, commonly including receivables, inventory, payables, and accruals. It matters because timing can create significant cash needs even when reported earnings are strong. An energy company may have receivables from customers, collateral or settlement balances, fuel inventories, and construction-related payables. I would monitor days sales outstanding, payment terms, and unusual movements, then distinguish recurring operating requirements from temporary project-related cash effects. In your answer, cover receivables, payables, inventory, accrued items, timing differences, liquidity, commodity settlements, construction activity, cash conversion, and the difference between accounting earnings and operating cash flow. Question 12. How would you evaluate whether AES should build, acquire, or partner on a new project? I would compare the alternatives on risk-adjusted NPV, expected returns, capital required, timing, control, and execution risk. Building may offer greater upside but requires development capability and carries permitting and construction uncertainty. Acquiring can accelerate entry but may include a premium or inherited liabilities. Partnering can share capital and risk while reducing control. I would also assess strategic fit, counterparty quality, financing capacity, and whether the structure preserves flexibility as market conditions change. Make sure to discuss strategic fit, risk-adjusted returns, development capability, capital requirements, ownership economics, partner quality, execution risk, valuation, synergies, and the option to preserve flexibility through partnerships. Question 13. What are the main risks in developing a renewable energy project? The major risks include permitting delays, interconnection constraints, equipment availability, construction cost inflation, schedule overruns, resource variability, curtailment, changing regulation, and off-taker credit. Financing and tax credit assumptions can also affect returns materially. I would map each risk to its probability, financial impact, owner, and mitigation. Examples include fixed-price engineering contracts, performance guarantees, diversified suppliers, hedging, contingency reserves, and conservative production assumptions. The goal is not eliminating risk, but pricing and allocating it appropriately. Discuss permitting, interconnection, construction delays, equipment supply, inflation, interest rates, resource variability, curtailment, off-taker credit, regulation, tax policy, and mitigation through contracts, diligence, and contingencies. Question 14. How would you assess a company's ability to service its debt? I would start with sustainable cash flow available for debt service, then examine debt balances, interest expense, maturities, amortization, and liquidity. Key metrics include net debt to EBITDA, interest coverage, and debt service coverage ratio. For project assets, contracted revenue and reserve accounts are particularly important. I would run downside cases for lower production, weaker prices, delays, and higher rates, then compare results with covenant limits and refinancing needs. Strong ratios are meaningful only if assumptions are credible. Focus on cash flow available for debt service, leverage, interest coverage, debt service coverage, maturity profile, covenant headroom, liquidity, contracted revenue, refinancing risk, and downside operating scenarios. Question 15. What is the difference between operating leverage and financial leverage? Operating leverage comes from fixed operating costs, while financial leverage comes from fixed interest and principal obligations. A power plant with high fixed maintenance costs may see earnings change significantly when generation or prices move. Adding debt amplifies the effect on equity returns because interest must be paid before equity receives cash. Leverage can improve returns in strong conditions, but it also increases downside risk, covenant pressure, and refinancing exposure, so it must match cash flow stability. In your answer, define fixed operating costs and fixed financing costs, explain their effects on earnings volatility, use an energy asset example, and connect leverage to risk, returns, and capital structure decisions. Question 16. How do you ensure accuracy in a financial model? I build models with clear input, calculation, and output sections, consistent formatting, and documented sources. I avoid hard-coding assumptions inside formulas and use checks for balance sheet balance, cash roll forward, debt movements, and key operating relationships. I test the model under extreme scenarios, compare outputs with historical results, and reconcile important figures to accounting systems. Before distribution, I review formulas systematically and ask another person to challenge both mechanics and assumptions. Be sure to mention clear structure, consistent formulas, independent checks, balance sheet balancing, source documentation, version control, sensitivity testing, reasonableness checks, and review by another person before distribution. Question 17. Describe a time you found an error in financial analysis. In a prior project, I noticed that forecast interest expense did not decline after a scheduled debt repayment. I traced the issue to a formula referencing the original balance rather than the debt roll forward. I corrected the model, quantified the impact on earnings and cash flow, and informed the reviewer immediately. I then added a check comparing beginning debt, repayments, new borrowings, and ending debt. That experience reinforced the importance of tracing formulas and testing changes. In your answer, use a concise star structure, explain how you identified the issue, quantify its impact, describe the correction and controls added, and emphasize accountability without blaming colleagues. Question 18. How would you present a complex financial analysis to a non-financial executive? I would begin with the decision required and the headline conclusion, not the model architecture. Then I would explain the 2 or 3 drivers that matter most, quantify the financial impact, and show the key risks or sensitivities. For example, I might say a project creates value at the base case but loses value if construction costs rise 10%. I would use simple visuals, avoid jargon, and keep detailed assumptions available for questions. Focus on leading with the decision, using plain language, highlighting material drivers, quantifying impact, presenting alternatives and risks, limiting unnecessary detail, and keeping supporting analysis available for follow-up questions. Question 19. What Excel functions and tools do you use most in financial analysis? I regularly use SUMIFs, XLOOKUP, index match, if statements, date functions, pivot tables, and conditional formatting. For forecasting, I use data tables or scenario switches to compare assumptions efficiently, and I build charts that make trends and variances visible. I also use data validation and error checks to reduce input mistakes. Strong Excel work is not just knowing functions, it is designing a transparent workbook that another analyst can audit and update. Mention SUMIFs, XLOOKUP or index match, if logic, date functions, pivot tables, scenario tools, charts, data validation, error checks, and disciplined workbook design rather than relying only on formula knowledge. Question 20. How would you analyze a renewable project's sensitivity to power prices? I would separate contracted output from merchant production because only the latter may be directly exposed to market prices. I would model price changes across a reasonable range, apply them to the relevant generation profile, and measure effects on revenue, EBITDA, cash flow, NPV, and equity returns. I would also calculate the break-even price and consider hedges, basis risk, and curtailment. This approach shows both the magnitude of exposure and the project's resilience under downside conditions. Discuss separating contracted and merchant volumes, price assumptions, production profile, timing, hedging, sensitivity tables, break-even analysis, cash flow and valuation effects, and distinguishing price risk from volume risk. Question 21. What is the difference between a regulated utility and a merchant power business? A regulated utility generally earns an approved return on an allowed asset base through customer rates, subject to regulatory oversight and service obligations. A merchant power business earns revenue from market prices or negotiated contracts, so profitability is more exposed to demand, fuel costs, generation availability, and volatility. I would value and forecast them differently. Regulated assets emphasize rate-based growth and allowed returns, while merchant assets require detailed market, dispatch, and scenario analysis. Make sure to contrast regulated returns and rate recovery with merchant price exposure, customer obligations, volatility, capital planning, regulatory risk, contract coverage, and the different valuation approaches used for each business. Question 22. How do tax credits affect renewable project valuation? Tax credits can materially improve a renewable project's economics by reducing tax liability or creating monetizable benefits linked to investment or production. I would model eligibility, timing, construction requirements, placed in service dates, transferability, tax capacity, and any prevailing wage or domestic content conditions. I would distinguish accounting presentation from actual cash value and test what happens if benefits are delayed or unavailable. Because policy and compliance matter, tax assumptions should be reviewed with specialists. In your answer, explain how investment or production incentives reduce tax burden or improve project cash flow, and discuss eligibility, timing, transferability, monetization, compliance, financing structures, and policy uncertainty. Question 23. How would you investigate a sudden decline in a power asset's EBITDA? I would bridge EBITDA from the prior period, separating volume, price, fuel, availability, contract, operating cost, foreign exchange, and one-time effects. I would compare actual generation with resource conditions, outage records, dispatch data, and budget assumptions. I would also verify that costs were classified consistently and that settlements were recorded in the correct period. Finally, I would determine whether the decline is temporary or structural, quantify the forecast impact, and recommend corrective actions. Be sure to cover production, availability, prices, fuel costs, contract settlements, curtailment, operating expenses, accounting classification, one-time items, comparisons with budget and peers, and forecast implications. Question 24. Tell me about a time you managed competing deadlines. During a reporting cycle, I had to complete a monthly forecast while supporting an urgent investment analysis. I listed deliverables by decision impact and deadline, confirmed priorities with my manager, and divided the work into reviewable milestones. I completed the time-sensitive analysis first, while protecting time for reconciliation and review on the forecast. I communicated progress early when assumptions changed. Both deliverables were submitted on time, and the process improved my planning discipline. Use a specific example showing prioritization by business impact and deadline, early communication, task breakdown, quality controls, stakeholder alignment, and a measurable outcome rather than simply stating you worked harder. Question 25. What questions would you ask the hiring manager about the financial analyst role at AES? I would ask which decisions the analyst supports most directly and how success is measured during the first 6 months. I would also ask how the team balances recurring reporting with ad hoc analysis, which AES businesses I would cover, and how closely analysts work with operations, development, treasury, and accounting. Finally, I would ask about model ownership, feedback, and opportunities to understand projects firsthand. Those questions help me assess both expectations and learning potential. In your answer, ask about the team's decision responsibilities, reporting cadence, business exposure, model ownership, development opportunities, performance expectations, cross-functional collaboration, and how analysts contribute to AES's strategic priorities. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.